The tariffs are here, and as the saying goes, our charts are no match for his tweets. But what if I told you the market dynamics were weak, well ahead of the sell-off on Friday? And this is the key to not getting wiped out by Trump volatility, or heck, even being able to profit from it. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points, including those market dynamics, and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY monthly time frame now that the January bars have officially closed out, what do we see in terms of candle structure and location? In terms of structure, we've got a green-bodied bar. However, the upper wick and the lower wick are both substantial, and it's really based on location. So let's segue to location on the bar-to-bar count. Notice that we have a higher high as well as a lower low, and this is an outside range. We've technically closed inside of December's range, just a hair below the opening print of the December monthly bar. So in theory, what this suggests is that we don't really have strong buyers who are willing to push price into blue sky territories and then close price there. But we also don't have strong sellers, because we technically took out December's low and the sellers were unable to close underneath December's low. So the green close for January probably gives structure and location a slightly more bullish edge, but I would start to incorporate a little bit of neutrality into the narrative here. The green close for January also sets up higher likelihood from a statistical perspective for a green 2025, but I'm much more concerned about the structural trend on the monthly chart. So if we're counting the overall trend, we have lows, soft higher lows, firm higher lows. We have firm higher lows here, soft higher lows on the August 5th panic, and we're just sitting at the highest high in the trend count. So in theory, is it possible that the monthly time frame can afford a higher low pullback? The answer is absolutely, coming from the highest high. So the next follow-up is, where does the higher low need to stay above? In my view, it's over this level right here, which is 525 roughly. I know it looks pretty aggressive, and absolutely it would be intraday, intra-week, but there's certainly an opportunity for a monthly higher low if we support here, find buyers, and then see price move in the upward direction. If you don't believe me, the reason I'm calling this level is, first and foremost, it's this previous little resistance on the monthly time frame chart, but also, if we bring out the Fibonacci's from the bottom of the move to the all-time high, this is actually above the Fibonacci 38.2. I would always prefer to see chart structure act before a Fibonacci level, but staying over the Fib 38.2 does classify this pullback as bull flag consolidation on the monthly view. Now, one more time, I want to be completely transparent that, of course, on the daily or even weekly time frame charts, there will be short opportunities if that pullback emerges. However, the key word in that sentence is if that pullback emerges. I want to talk about the strength of the trend here by bringing out the 20 SMA on the monthly time frame chart. Let's remove our Fibonacci. Notice the distance between price and the 20 SMA. And notice also how the 20 SMA might meet us there for confluence around that 525 if a deeper pullback emerges. Now, beyond that, if anybody's calling for Armageddon market crash, oh my goodness, we tested the all-time high, but we didn't close up there, I would just point to the fact that, and we do this every single month, right? Let's go back to our classic examples of the great financial crisis, and let's take a look. When does the painful moment happen? It's after the monthly trend flips to down. We have a double top. Notice that we've already tested the monthly 20 SMA. We form a lower high on the monthly time frame chart. We form a lower low from here to here, and then really bad things happen in the market. So does this look anything like what we're dealing with currently? The answer is absolutely not. And we can, of course, do the same exact thing with the dot-com bubble bursting, right? So if it's a valuation thing and it's not going to be a housing crisis, right, we can use this comparison and notice that the chart almost looks identical. You have a double top. You have previous lows that are very close to the monthly 20 SMA. You form a lower high on the monthly chart, a lower low on the monthly chart. The monthly trend is down. And then we see painful moment number 1, 2, and the big one down here, number 3, the capitulation breakdown. So if we compare these two looks to what we're dealing with currently in the market, the trend here is far stronger and in a much better place. One counter argument that might suggest a pullback could be imminent is just the idea that we have completed the measured move from the biggest bull flag I think I've ever seen, right? If you take the move from the sickness low point A to the rally high point B to 2022's pullback low point C, the measured move is up here. And we've hit that over the last couple of months. But is it possible that we pull back off of a 100% extension? Sure. Absolutely, not a problem whatsoever. We all know, based on what we just walked through, that we're really looking for 525 if there's going to be a monthly high or low opportunity. Let's drop this chart now to a weekly time frame chart, because on the weekly, there's actually a little bit more nuance that we can read into here. The first things first, of course, which is just candle structure and location. If we're talking about structure, we of course have a green-bodied inverted hammer. So the upper wick undoubtedly suggests that sellers did step up near the highs, and they were able to push prices back down towards, really in this case, just the midpoint of the weekly range. Because we have a green-bodied bar, we know that the close is still over the opening print, so there really wasn't any range expansion underneath the open to close out the week for a red-bodied bar. It just simply didn't take place. So from that perspective, it's bearish, but it's not really as bearish as it could have been. If we're thinking about location on the bar-to-bar count, we do technically see a lower high as well as a lower low. So you can start to see on the weekly chart that maybe things aren't fine and dandy. However, let's scale out of the bar-to-bar count for a moment and consider the overarching trend. We still have lows. We have higher lows, soft higher lows, firm higher lows, soft higher lows. We attempted to set firm higher lows here. Recall the overshoot, which did technically make me start thinking, okay, let's get a little bit more bearish than bullish underneath that level. The recapture and the previous weekly close up here changed tone immediately back to the upside. And we also talked about last Saturday the fact that we avoided the head and shoulders, right? We had left, we had head, and we had the potential for a right shoulder if we turned around on this previous weekly open immediately to set the right shoulder. That didn't happen. So the reason I walk through this in such detail is to just point out the overshoot here might be similar to the overshoot that we're dealing with here. We technically opened underneath from Monday's deep seek gap down. We opened underneath the key area, which was roughly 600. But where did we close the weekly bar? Back over 600. Is it fine and dandy? Not really. The upper wick is somewhat of a concern, but I wouldn't prematurely jump the gun on the short side of this weekly time frame chart. I think it's very possible that the weekly can sustain a higher low around this area. We don't often look at weekly 20 SMAs, but it's still the orange moving average on your screen. If we're above that, it's very difficult to say anything bearish about this chart. So lo and behold, the key weekly level just becomes last week's low. If we take out last week's low, it's probably fair to start saying that we have a decent amount of overhead supply. Anybody who bought the gap down on Monday's open, of course, would start to get concerned about their position and possibly close out. Now, if that's the case, then we're not oblivious to the fact that, sure, maybe this starts to emerge as a weekly double top, in which case I would start to have further concerns about the weekly trend if we drop back down underneath 585. I would still lean into this level quite a bit here. If we're above this level, very difficult to be bearish. If we start trading underneath this level, of course, concerns would increase. Let's take a look at this through the lens of a couple of Fibonacci measurements from here to the all-time high. Obviously, still well above the Fibonacci 38.2. That's not an issue. Probably sides more so with the bullish narrative so far. If we come in from the low of the, the election move to the high, of course, we're still over the Fibonacci 38.2, and it's the exact low of last week's bar. So one more time, that's probably a key area right there. You could split the hairs here around 595, 600. We'll talk more about it on the hourly chart in just a moment. But if we're above all of this, which is currently the close of last Friday, then I think one more time, it's premature to get aggressive on the bear side here. If it's going to turn into a double top, let it break through the neckline. Let it show us the lower low in the trend count. Let's quickly come in with the anchored view apps because this is also pretty compelling. Notice that the gap down supported directly off of the previous all-time high anchored view app as well as the breakout anchored view app from over here, and we've closed above the entirety of the cluster. One more time, if this is going to turn into a double top, of course concerns would emerge when we're in the anchored view app cluster. If not, the true neckline break would put us underneath the lowest anchored VWAP that we're dealing with here. So are we there yet? The answer is no, probably maintaining slightly more of that bullish edge here on the weekly time frame chart with acknowledgement to the upper wick from last week's candle. Let's go out to a volume profile just for the sake of being completely thorough in our investigation, and we'll drop this down to a 6-month chart. And this, I think, really just reinforces the fact that if we can break out through the highs, I mean, it's a high volume shelf at this point, just by nature of being the all-time high. If we break it, it's a blue sky breakout. And I wouldn't really start to think that big bearish concerns emerge until we break underneath the point of control. And isn't that funny how it aligns perfectly with the key level we've just described? If we're under 585, concerns would emerge. It also makes sense from a volume perspective here. Let's get on down to a daily time frame chart. Let's get really granular here and see what's going on from this perspective. The first things first, of course, it's evaluating this week's expected move. The expected move is in this gray box right here. And if you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 612.27, implying a higher high in the trend count. And by nature of being such, it's an all-time high. And if we're contained by the lower bound, the number is at 591.29. Unfortunately, this would imply a lower low. So the weekly expected move is a little bit more neutral, which in my view might align more so with the upper wick we were just describing on the weekly investigation. So neutral on expected move, but we can lean into the daily trend. Remember that in last week's episode, we said that a base case was looking for a higher low to emerge on the daily time frame chart because we had the potential to pull back from the highest high. This was a brand new all-time high on the Friday of now 2 weeks ago. So, little did anyone know that the DeepSeek news was going to come out over the weekend and, of course, send us on a big gap down. But regardless, this is still an opportunity for a daily higher low, and this has turned into our base case. So as we sort of manage against the base case, has there been anything here to violate the low of Monday? And the answer is no. We talked about on the weekly time frame chart how that's going to be a key level, right? As long as we're above that, I think it's fair to say that there's probably more of a bullish edge. But on the daily time frame chart, Friday's bar starts to get really interesting because what it does is it sets an equal high back here, meaning that we can afford a higher low pullback on the daily relative to this previous low. Now, where would the ideal level be for a daily higher low? Of course, it's this one right here, 599.65, 600. It's the previous lower high in the trend count. Remember that we had our resistance trend line looking something like this. We talked about the break in here. We talked about the equal high in the inverted hammer, the fact that it was acting as support. And look at what's happened through really ever since Monday, so Tuesday and onward, we've really seen buyers step up at this level over and over and over again. And a great sort of point to make here is that on the daily time frame chart, we're actually one time framing in the upward direction, meaning that every single daily candle has produced a bar-to-bar higher low since Monday's gap down. So as long as we're over 600, I would still give the buyers the benefit of the doubt here, looking for the next daily higher low in the trend count, and then a move back up into the equal high, seeking some sort of breakout into a blue sky move there that's over 609.75. Now, I do want to concede a couple of points here with the Friday breakdown, because it's not rainbows and butterflies. We know that the weekly chart has that upper wick. Friday's candle is pretty aggressive, right? We technically opened up on a gap up here, rallied to test the all-time high, and then the aggressive failure happened back down into the Thursday range. But it's more important than just the Thursday range. It's this level that we've dimmed back just a little bit. You might recall from last Saturday's update or even Wednesday's, we were talking about 603 with quite a lot of importance because it represented the bottom end of this balance range and also the origin of the Powell plunge. You can see it acted as resistance, and it was the gap close from this area over here. So the fact that we've closed underneath that on Friday does not really give me a warm and fuzzy feeling inside. I'm still going to give the market the benefit of the doubt at 600 and 599.65, but managing against this base case starts to become much more important on smaller time frames because of the lack of the ideal hold of 603. And what I mean by that, you can see this on the hourly right now actually. What I mean by that is on the hourly time frame chart, you can see we were in a clean uptrend, and the ideal next spot for a higher low would have been 603. If the market could have held up over that level, great. The trend count remains up on the hourly chart. We're pulling back from the highest high in the hourly trend count, right? We had highs, higher highs on Thursday, Friday, higher highs in the morning session. 603 would have been ideal. But notice the afternoon, the very final hourly bar, it's sneaky. look at the upper wick on that. It's actually a perfect rejection of 603. I'll zoom in even further, right? Take a look at the upper wick right here. Now, I'm not trying to insinuate that, oh my goodness, the market's going to crash. There's this inverted hammer in the last hourly session of the Friday. Like, that's not what I'm getting at. What I'm getting at is it would have been best and the market would have looked the strongest from a trend count perspective if we could have closed over 603, or if just in general, this could have held as a potential higher low. So now it needs to be the must watch level becomes 600. Because if we're managing against this base case that this is going to be a daily higher low, things are all fine and dandy, we're looking for a move to blue sky territories, then ideally the hourly trend just would have remained up until we produced a higher high on the daily time frame chart, not just an equal high, right? That's the key right there. So 599.65 becomes important. If in this upcoming week we end up opening in this range, ideally it's a Brigade bolt over 603 to retest $600.75. From there, the next phase needs to be consolidation that cannot afford to get underneath 603 and ideally comes up to test the all-time high for a short proximity test, meaning time-wise, short distance here, and then some sort of breakout to a blue sky territory move. If the market ends up consolidating down here and breaking underneath 599.65, the daily base case scenario of using this as a higher low is jeopardized. Why? Because of course, from a pattern perspective, you would just say, okay, this maybe starts to imply head and shoulders on the hourly, reversal incoming. We're testing the equal low now on the daily time frame chart. And what does that do from a trend perspective? It jeopardizes the strength of the daily trend that we're trying to reverse in the upward direction from here to here. So if we're testing this low after an equal high, just like on the weekly chart, we maybe have, a larger top here and a larger top here. It's sort of fractal in the sense that maybe this also acts as a double top, and underneath 599.65, the neckline becomes a real threat, which of course would put the daily trend back to down underneath 595.85. So you can start to see how compelling this 599.65 level is, this 600 round number if you'd like, into the early stages of this upcoming week. The market has not been trending cleanly in this sort of range through here. So I would say that one of the best things you can do in these circumstances, when the daily trend is not clean, when the weekly trend is starting to neutralize a little bit, is to really just manage those expectations. And we talked about it in this box when it was a little bit more obvious that it was like just a volatile range. But even as we're trying to resolve a daily trend here, I think it's still worth keeping an open mind to a wide variety of outcomes, not being a hero, not getting attached to a bias. I think that the higher time frames still support the bullish thesis, but generally speaking, as a day trader, you want to be open-minded around these levels here, specifically that 599.65 we've talked about in quite a bit of detail. Let's come in here with the Fibonacci's from the bottom of the move to the all-time high, and we can see that the 38.2 is not quite at the low of the Monday session from last week. The 50 SMA is tangled up in here as well. So this probably supports more of the bullish thesis, so to speak, so far. If we take a look at the hourly time frame chart, let's zoom out a little bit first, and then we'll throw on our intraday anchored view apps. We're right at pretty much the do or die zone, which I think makes sense, right? This is a key area. It's a key zone that 599.65 needs to continue to hold. If it does, we remain above the anchored view app cluster. And once again, seems reasonable that an equal high can be produced, and then we're looking for a breakout to blue sky territories. If we start to drop underneath one more time, I think that this is aligned so far with the analysis we've conducted, saying, okay, buckle up, it's not going to be so easy underneath that little section of the cluster. Let's take a look, what could we say here additionally about the hourly chart? Anything interesting? I was just going to sort of reinforce the idea that technically speaking, if this market was going to be as bullish as it could have been, it would have been gap fill reversal here on Friday, consolidation, and then a Brigade bolt early this upcoming week. Obviously, the tariff news doesn't really support that as being a primary outcome. So that's the deal. I think 600 is your big top watch. We've talked about it until we're blue in the face. Let's take a look at the market internals, because this is the context I was referring to in the intro. If you're not familiar with the internals, first of all, check out the video tutorial in the top right-hand corner. And now, what I mean by being able to avoid Trump volatility or not getting wiped out by Trump volatility is exactly what we're about to talk about here. So let's firstly use Friday as an example, and then we'll take an overall assessment of what's going on. Friday, and this is not the case in the ES futures because we know that technically this is a little bit different than the cash ETF over here in the spiders. But let's just say, and it's not even that we're saying, it's a fact, that the cash market was trading at resistance near all-time highs into the afternoon before this big breakdown here, okay? So that's the context of the location. We're trading near resistance on Friday midday before the breakdown, okay? At resistance, that's the key. If we go back to the market internals, did we have substantial volume inflows coming into the market, or was it more lackluster? Again, ignore what happens after the fact, but before the breakdown, I would argue that these volume flows, very lackluster. If I hide this, you can actually see that mid-morning on Friday, we were hardly trading at 1.1, 1 point, maybe just before it happens, 1.5 to 1 positive on the breadth scores. So you tell me, if we have a 1.15 to 1 positive on breadth and we're trading at resistance, does that really tell you that we have enough, quote, gas in the tank to break out over the all-time high? Probably not. You would want to see breadth ratios that look like this, much stronger, around like 4 to 1, 3.9, 3.5. Thursday's breadth is what you want to see if there's going to be the potential for a breakout. So that was a no-go. You want to be very cautious. And this is what I mean by like avoiding the Trump volatility wipeout. When the market internals are telling you that we do not have full strength for a potential breakout near resistance, you probably want to do a couple of things. You either don't want to be long, trying to get ahead of the breakout, or if you're already long from lower on in the session, you want to be thinking about closing profits, being a profit taker at resistance, or you just want to think about, okay, instead of taking everything off the table, let me at least put in some sort of trail stop, right? Can I put a trail stop in the market that maybe prevents some sort of liquidation off of these highs, right? So that's first of all with breadth. You could take the same exact approach here with the advanced decline line. Notice how we open negative, we climb over the zero mark, and then it's a little bit of positivity here, but compare that to a strong day in the market. Strong is when everything is firing on all cylinders up and over the previous day's settlement. That would be moves up here in trend higher zone, as we call it, over 1500. I mean, we opened negative. All right, so that's not really giving you a whole degree of confidence at resistance. Again, the point is to bring in the context of where you are on the daily resistance, right, at the all-time high, with pretty lackluster internals. Now, I'm not going to sit here and say, like, okay, you should have shorted this market on Friday at the all-time high. That's not the point. The point is to be much more defensive if you were long, with a trail stop, being an aggressive profit taker, or just not looking for a breakout in the first place when the internals are this neutral, right? The index score here, really, really lackluster. I mean, the readings there are 5. Substantial reads are usually over 15 positive or negative, right? So not even a third of the way there to substantial. The cumulative build out of the tick, completely flat. Usually if you're having a strong trending day on your hands, you have a 5,000 by noon. 5,000 is the close, but a 2,000 read by noon. Net positive, negative, depending on the direction of the trend. But in this case, it was up, right? So we would have wanted to see a 2,000 mark by noon. Is that the case? No. I mean, we had 638, absolutely abysmal style cumulative tick compared to the trend that we had intraday. So this, I think, is paramount as we're trading in a new era of volatility. And again, it doesn't matter how you feel about the policies, this, that, the other thing. Like, keep the politics out of the market. You just need to understand that things can change at the drop of a tweet, quite literally. We've learned this as of course, Friday's session, as well as the end of day on Thursday. All right. So if you're not using context, you're trading blind. It's like trading blind. That's the equivalent here from the internals. Generally speaking, what's the expectation moving forward? Did we see stronger selling come in as the Friday move was taking place? Yes. Look at the substantial volume outflows. I wouldn't say we get into trend lower zone on Friday, but certainly approached it. The index score gets fairly negative, and the cumulative build, coming from flat without having the momentum of the morning to close underneath negative 2,000, it's a step in the right direction for the sellers. So I would think that we want to be slightly on edge given what's happened here into the Friday close, the fact that the exchange level data actually supports stronger sellers starting to get active. This is not so much a liquidation break like what we had on the Thursday afternoon. Thursday afternoon was retraced almost instantly, right? It's not looking like it's going to be retraced instantly, and it's got much more of a backing behind it from an internals perspective, right? Just look at Thursday. Thursday had substantial volume inflows in trend higher zone, and then of course we had an okay cumulative build here. So we've spent a little bit of time, probably a lot more time than normal on market internals, but again, this context is what you need if we're trading a market environment that can flip-flop on a dime. What would the counter be? Just to give you an example, I want to be really thorough in this because I think it holds the most power through the analysis for active traders, right? if we had a cumulative build that was at 2000 or better, if you had a volume flow read that was like approaching, a trajectory that would get us to substantial inflows on the session, if you had breadth reads that were, like we said on Thursday, 3-to-1, 4-to-1 positive, if the advanced decline line opened here and was in trend higher zone, if index score was at 15, this is probably a pullback that we would have been more interested in buying, right? Instead of like selling the whole thing through the day's session. Maybe we would have seen support off of this level and something like that if you had a stronger backing at the exchange level, right? So that is the market internals, and that to me is absolutely paramount as we move into this new volatility regime. Let's take a look at the market profile here. What do we see out of this particular chart? Notice that value is mostly unchanged here. Oops, I don't know why that missed so badly. There's value. We missed the highs by quite a bit. There's value. Here's value on the Thursday session, and value on Friday ends up being overlapping to down, or I guess just completely outside of value relative to Thursday. But point being is that the point of control actually did migrate lower with price. That's pretty substantial considering what's taken place. At first, the point of control was up here, and you can actually reference our X account. We had posted this probably closer to like 3 o'clock. As of 3 p.m. Eastern, point of control was still at the high of day. The fact that it migrated lower does support what we just saw from the internals perspective, which is just that, it's probably some more substantial selling, which was able to flip this to the downside. You technically have a double distribution with single prints here in I period, which pretty much aligns with this previous resistance. We've been talking about 61.15 quite a bit in the market, so I would continue to use that as a demarcation line here in the ES from that point of view, all right? So let's jump back on over to the platform here. Let's take a look at our QQQ nasty NASDAQ. Let's jump it up to the monthly time frame chart. Let me know in the comments, and you can let me know now instead of waiting until the end. But did you enjoy that look through the internals? Is that helpful for you? To me, I really mean it when I say it. If I'm trading without a screen of the internals up, it feels like I'm trading blind. It's like I have no reference as to like, okay, how aggressive or how conservative should I be with my positions? Anyways, QQQ, what's going on with the NASDAQ? We all know that the December bar was nasty. It's the big inverted hammer. Everybody said, oh, the market's going to crash, right? We would take the same approach as the S&P and just say, okay, are we in a monthly downtrend? The answer is no. We have, from a candle perspective here, I would call it, people say spinning top, doji, whatever. I just call it an indecisive candle. Upper wick, lower wick, probably both larger than the candle body. We have a lower low on the bar to bar count and a lower high. So unlike the S&P 500, a little bit of more bearish edge here on the monthly time frame chart. Not enough for me to say like, oh my goodness, we should short this into the ground, because keep in mind that we looked underneath the previous month's low, a bearish inverted hammer, and then we closed inside of the upper wick range. If we had stronger sellers here, that should have been a no-brainer, like, okay, here we go, lock and load underneath the inverted hammer low. Let's run with it to the downside big time. That just simply didn't take place. From a monthly trend count perspective, we still have lows, higher lows, soft higher lows happening here. I would argue that your firm higher low on the monthly QQQ just wants to be around 450. If there is a pullback, something that looks like this is A-okay from that perspective. Let's check in on our good old friend, the Fibonacci's from the bottom to the top, well above the Fibonacci 38.2, all set from that point of view. We won't take a look at the previous tops from 08 and the dot-com era, but we will throw on the 20 SMA just to reinforce once again. Look at the distance between that 20 SMA and notice how it could tie in beautifully with that 450 level. Let's drop it down to the weekly time frame chart now. Let's see what we can see from this perspective. I'll continue to reinforce this idea, which is just such that, as long as we're over this previous all-time high on the weekly time frame, I would still argue that the buyers are in control here. The trend is up, although I would acknowledge that we have the opportunity for it to flip to down if we break down underneath 503.25. That's the key level we've been tracking for quite a bit, and we would have a weekly lower high on the table. We're not there yet, and once again, I think it's inappropriate to jump the gun here, but that is the key watch. 503.25 on the weekly has the possibility to change this into a lower high double top. 1, 2, lower high notably. Under the neckline, a lower low there absolutely changes things. We're not there yet, and if we think about candle structure and location out of the QQQ weekly, we've got something similar to the S&P 500 where it's inverted hammer-esque. Certainly a green-bodied bar, so not as bearish as it could have been. Closure in the midpoint of the range, and also inside of the previous week's range. I think that that's noteworthy also. If we had closed underneath the previous week's low, that would have been more telling that, okay, let's buckle up for a little bit of a rocky ride here. but not so bad, closing inside that prior range. If we take out the Fibonacci's from the August 5th low up to the high, we're still over the 38.2. If we come in from the election low to the high, we're still over the 38.2 via a close here in the previous week's bar. Let's check in on, of course, our anchored VWAPs on the weekly chart over the entire cluster, although we gapped down on Monday with the DeepSeek news, of course, below the top two. We ended up closing back above to the top. So once again, inappropriate to be prematurely bearish here on the weekly time frame chart. We can quickly look at the volume profile, and we'll drop this to a 6-month chart as we do. And what do we see from this point of view? Notice that on the gap down, we actually held, I know the white line actually just covered it up, but we held the high volume node. Look at the high volume node right here. It's not the point of control like what we had in the S&P, but it's still a high volume node there. So last week's low becomes critical. If we take it out, things get a little bit more dangerous, and it becomes absolutely more dangerous underneath 503.25 as we've gone on and on and on about. Let's take a look at the daily time frame chart, and what we'll notice over here is much more of a neutral trend relative to the S&P 500. Let's not jump the gun, and we'll still firstly evaluate the expected move. The upper bound is at 535.17, implying, technically speaking, a higher high. I'd call it an equal high for all intents and purposes. If we make a low down here at 509.49 and are contained by the expected move, it's an equal low with the bottom end of the range. From this perspective, the pattern traders are shouting from the rooftop, it's gotta be. It's just gotta be an inverted head and shoulders, and it very well could be, but I would not want to see a retest of 510 at this point. If the daily trend is going to flip to up, then we need lows, we need higher lows, and it's paramount that we do not see any price acceptance underneath 518.50. If we're managing against this base case that we're looking for a daily trend reversal out of the NASDAQ, really don't want price underneath the 50 SMA. Otherwise, you get too much of a high, you get too much of a lower high. That's that weekly lower high. From here to here even is technically a lower high. Back down to an equal low, at that point, you're really just dealing with range compression, and you could probably, build an argument for trend lines like such, but an equal low opens the door for a flush, and at that point, we know that the weekly trend is jeopardized underneath 503.25. So really paying very close attention to 518.50. If we're above it through the majority of this week, I would maintain a more bullish stance on the market. If we start to, funky zoom, if we fall underneath it, I would start saying, okay, larger concerns are emerging here, and I'm not quite convinced that we have an easy trend to be dealing with. Here on the NASDAQ, it's much easier to just say something like, okay, look at the sideways action here. One more time, I just fall back into the idea and the mantra of let's just manage our expectations when the daily trend is practically non-existent. This is about as sideways as it gets. We have not seen markets like this in quite some time, right? This is like maybe getting a little bit close, but really what this reminds me of is the quote GFR, the godforsaken ranges that we were dealing with over here. So this was 2.0. We tried to avoid 3.0, but it looks like we're turning into a 4.0 with a much wider range. So, now is probably a good time to remind folks as well, when you're dealing with higher volatility, stop losses probably get a little bit wider, which means if you're trying to keep your risk in check, position sizes should probably be reduced if you're trying to keep the same amount of dollars at risk per trade. So always a good reminder. I think that, risk management is always crucial when it becomes a neutral trend here. If you just, you can easily die a death of 1,000 paper cuts basically when you're trying all these different setups and the market's not trending, right? So being aware of that is certainly helpful. Let's take out the fibs on the daily time frame chart, then we'll navigate to the hourly. Something that looks like this. 38.2 is not really aligned with the 518.50. It's within spitting distance, so maybe just a general hold of this area, not getting back down to the 61.8 would be the take from a Fibonacci perspective here. Like the S&P, every single daily bar has produced a higher low, so we are technically one time framing there in the upward direction. Notice that we open on the gap up, just like the S&P fail towards the highs, which is technically a lower high, unlike the S&P made an equal high, and then we've closed inside of Thursday's range. 518.50, we've talked about it until we're blue in the face. Here's the hourly time frame chart. Notice that the hourly trend was pretty clean. We had lows, we had higher lows happening here, and ideally the next higher low would have been up and over 523.14. Just like the S&P, we did not get that. So any price opens in this area, I would maintain a cautious stance. Brigade bolts here, bring on the shorts, looking for risk reward, treating that as an individual instance of a trade. If we get into this territory, it helps, but I probably maintain more of that bullish stance, looking for this risk reward, and then really much more of a bullish stance if we can take out 533.25. Any sort of movement that looks like this, so let's say we hold, Brigade bolts start to put the longs back on, and then a Brigade bolt here, it's rock and roll up to the all-time high 539, which would preserve the weekly chart. We would say, phew, thank God, we've not gotten another test of 503.25. We're good from that perspective, okay? Let's check in on our intraday anchored view apps for the NASDAQ, right at the entirety of the cluster, which, this probably isn't shocking. The more sideways a market goes, the more these just find an equilibrium towards the center of that. So, I think if anything, it just reinforces that staying over 518.50 just maintains a subtle bullish edge here for the NASDAQ, right? Let's take a look at the NASDAQ market internals, and we'll save the entire full breakdown of what's happening here. It was a little bit stronger. Let's admit that. That's, of course, one thing to point out. A little bit stronger here out of the NASDAQ into the midday session. Of course, closing red, closing big red over here. So is it fair to say that stronger sellers are starting to get involved in the market? Probably. And if you've been tuning into the pre-market preps, we actually even had been saying throughout the duration of the week that the NASDAQ's probably the place to be looking for the short, not the S&P. So not shocked to see a little bit more of a severe lackluster trend, I suppose, on that daily time frame chart we were just describing. Let's take a look at the market profile for the NASDAQ. And one of the things I actually just remembered that I had brought it up, but I've omitted it for the ES. If you want to read more about delta imbalance charts, order flow charts, that's fine, and I would encourage you to do so on different time from now. But one of the other things we saw towards the highs was just aggressive sellers starting to step in, namely the 602 flag here before the larger breakdown. So all this is telling us is that more activity was going through on the bid. Sellers were selling into the bid rather than looking for a fill on the asking price, right? So that dynamic between gauging whether or not we had stronger sellers or buyers did start to shift towards the highs. So order flow can help with spotting inflections in the market. That's always been the case, but it might be extra useful when we're dealing with things that can change very rapidly, right? Order flow will show you that probably more quickly than a candlestick chart. Anyhow, back over to the NASDAQ to keep things on track. What do we see here? Very similar commentary to the S&P, where we have value that's mostly sideways. The only difference is just that on the Friday session, the point of control did not flip lower. It could be a time-based thing where we're going to keep an open mind to this flipping lower. Generally speaking, if we stay within this range right here, and you could even, say it's the top of the M period prints back there around 21,650, which actually aligns with a key level we have on the NASDAQ futures. If we're under 21,650, neutral in this range. If we're back above, fine. Maybe the point of control does end up ultimately acting as a magnet around that 21.9, 21.8 to 21.850 was the key zone that we had been using. It looks like the point of control closed above that on Friday. So an interesting divergence, so to speak, in the NASDAQ side of the market. I'm not convinced that I want to read into it too much out of the market profile. This would be a more minor data point. I think that there's more of a timing issue here. If we look at the low of day, it is a poor low, and it's also, now that I'm just, it's not quite there. I was going to say it might even be mechanical if it aligns with the value area low here. Not quite. But regardless, that poor low should need some sort of repair. So early on in the week, if we just test and break below and stay below Friday's low, you'll just know that, okay, stronger sellers are getting involved, right? In a stronger environment, you would repair the low and almost instantly come back up into the value area of the Friday session or whatever session you're trying to repair the low from. Anyhow, that's the market profile nuance out of the NASDAQ. Let's take a look now at our good friend, the Rusty Russell. Let's go on up actually to a monthly chart. Monthlies have closed. Let's not give the Russell the short end of the stick here. Let's just grab a little bit more time so we can see relative to the sickness consolidation, as we'll call it. What do we see here? The thing about the Russell monthly chart is that it's sort of at odds with the daily and weekly chart. And the reason I say that is because this large standing, zone down here took forever to resolve. That's a 2-year balance range for the most part. And the fact that the monthly chart ever so slightly is creeping out of that with higher lows, it is constructive, especially pulling back from a new all-time high, which was set back here just a couple of months ago in November, of course. So with that, the monthly trend is trying to remain somewhat up, and the monthly bar here is a bit more compelling, where you can see that we looked underneath the 2 previous monthly lows and then closed inside of those 2-month ranges. So the IWM, and we do have issues with it on the daily and the weekly, and we'll get to that in just a moment, but the monthly does look pretty solid here for continuing the trend in the upward direction. Of course, the big arbiter of price is just the 227 level. Can we get some sort of action over the hammer high to get back to the all-time high and potentially move into blue sky territories? That is yet to be seen, but that's what's basically set up here as of January's close. I'm really actually, the more I look at this on the monthly chart, and this is the first time I'm looking at this for the first time with you here through this recording, really great looking lower wick. Have to give credit where credit is due. Nice hammer candle for the IWM buyers on the monthly time frame. Doesn't mean it needs to resolve, but for now, decent little look. Let's come in here with the Fibonacci's from the low to the high. And lo and behold, we're right at the 38.2. It just gets better and better, doesn't it? How does the trend line look? Can we throw a trend line on this? Pretty good. I'm not usually a fan of diagonal trend lines, but that's looking pretty sharp there. What else can we do on the monthly? That's probably it for the monthly perspective. We'll continue to monitor back to the highs, basically. Let's go to a weekly. On the weekly, we can, of course, check in on our anchored view apps and such. So this is where we say, okay, looked great on the high time frames. Medium time frames, not really the best looking weekly bar here. If we do something that looks like this of course is the big bad breakout level. It's 227. Notice the upper wick here looks over, technically by a hair, the previous weekly range, and we close under right at the previous week's low. I know that my white drawing line is right through it, but there you go. You can see we've closed underneath the previous bar's low. We've made a lower low. This is where, again, those concerns start to emerge. It's way too early to say that this is going to be a head and shoulders. I would really need to see price underneath something like 215 if I was going to make that call. We're not there yet. It's very possible that a lower high is brewing, but if we can get that 227 to resolve higher, the monthly chart looks pretty darn good. Monthly, again, the monthly moves slow, but we'll watch out for that when February's close comes around. What else can we look at? Of course, it is going to be our weekly anchored view apps, not the intraday, not yet at least. Rejecting the top band, but still over this, so I'd keep an open mind. And remember that this lower cluster right here, these two, represent the width of the balance range from back here that we broke out of. For now, it's a failed breakout, right? It's continuing to look more like a failed breakout than a successful one, but if we can stay over this, it might give a second sort of wave of hope, and again, we'll maintain that more so monthly optimism. But let's unfortunately take it down to the daily time frame chart, because the optimism only goes so far. Really not the best close on Friday, and not a shock considering what we just saw on the weekly time frame chart anyhow. But here's the expected move. We'll talk about it first, then we'll get into the nitty gritty. Upper bound is at 232.66. Lower bound is basically the gap close from CPI back here, and that's at 220.25. Technically, it's 220.27. And just getting to structure, right? Maybe we get a higher high over this. Maybe we get a lower low under this. Pretty neutral from an expected move perspective. The close under 227 does not sit very well with me, especially noting that on Thursday, it looked like prices were trying to actually maintain acceptance above, right? We had earlier in the week, of course, not impacted by DeepSeek, but we had a little bit of struggle. Thursday's move back over the level was like a second wave of optimism, to continue using that word. And then Friday just says, nope, sorry, we were just joking with you. So I really think we want to keep it simple here in small caps. We're not going to spend too much time on the daily. It's just 227. You're either over and we're bullish, or we're under and we're bearish. 227 is the arbiter of price. You could call this a New Balance range, hashtag not sponsored. Although with the marathon coming up, we would love it if New Balance could reach out and sponsor the show. Wouldn't that be something? So this is a New Balance range over here relative to this previous balance range. If we break out of it to the downside, I think the targets are just easy, right? You've got your CPI gap close, or you've got the origin of the Powell plunge, the upper edge of the weekly expected move. With that, I said we weren't going to spend too much time there on the daily, so we're not. Here it is on the hourly. You can see the acceptance below, the Thursday spout of hope, and then Friday just crushes it with the afternoon upper wick, inverted hammer, rejecting 227 into the close. So very simple chart. Keep it simple. Don't overcomplicate it. 227. We can slap on the fibs here. Just for a quick check-in, we're technically over the 38.2. You could monitor this at 224.25. You could use that as an arbiter of price, and you could also come in here with the anchored view apps intraday. And it's giving us that funky zoom again. Let's see. Nope. Okay. Let's go 15, and then let's go back to an hourly. There it is, playing nice. Thank you, Thinkorswim. They were kind enough not to push the update this weekend with the Trump volatility. They actually made an announcement about that. But it's clustered right there. Any surprises? 227, it's the level. Let's move along. Let's take a look at the Russell market internals. What do we see here on Friday in particular with the break back down underneath the key level? We didn't have substantial volume outflows, but they were undoubtedly bearish, that's for sure. We had an advanced decline line move lower and a cumulative build that moved lower. Thursday, I think, is the day to interrogate out of the Russell, where we had that acceptance back over the level. We faded from trend higher zone instead of staying in it sideways. Volume inflows, really not all that impressive, and the cumulative build completely sideways there. Again, the name of the game here is probably the bears retain the edge in the shorter time frames. Let's take a look at the Russell market profile, and we'll see what's going on here before we ultimately move back into our S&P sectors. Value is here, 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 and here. Friday, of course, overlapping to down, point of control definitively lower. I think that the balance range seems more susceptible to break down below the bottom of the new balance to start testing that CPI gap. We will see what happens through the duration of this upcoming week. Let's get back to the platform here. Let's start talking back about our S&P 500, Old Faithful, and we will evaluate our sector's performance. Who is leading, who is losing, where was the weight? We have communications up 3.44% on the week, discretionary 2.48%, and then financials 1.4%. At the bottom of the barrel, it is the energy sector down 3.69%. The sine wave continues on the crude oil chart. TLT underperforming here, down 45 basis points. Industrials and real estate as well. Not the worst thing in the world. If we're thinking about rotation in the market, these sectors up here are still heavier weight risk on style sectors. We're not seeing this push to the upside brought to you by like defensive utilities or consumer staples or something of the sort, right? Let's take a look through the structural charts. What do we have here? A little bit of inverted hammer, upper wicks starting to emerge towards the all-time high test out of the XLC. Fine. I mean, all-time highs are bullish. If it pulls back and sets a higher low, I maintain a bullish stance here. No issues out of this as long as we're over 99.15. Bullish for the market. Again, keep in mind that intra-week, a little bit of a pullback here that emerges could be bearish for like some short-sighted trades to develop. However, if we catch for the higher low, the general premise is that buyers are still in control, right? And that'll stand true for a lot of these charts. Here we go with the XLY, right? Generally speaking, the idea here is some sort of inverted head and shoulders. If we can get acceptance over the neckline, the all-time high is the target. The interesting thing about the XLY, of course, excuse me, and even the XLC, I'm sorry, I just omitted this actually. We have Google and Amazon earnings this week. It's going to be a big deal for both of these sectors, namely Amazon for the XLY and Google for the XLC. But anyhow, this idea here, if we get positive earnings from Amazon, looks pretty solid. Tesla is sort of the drag on the discretionary sector right now. So line in the sand has to be 227.50. So far, so good. Probably maintains more of that bullish stance for now. We're out of this short-term threat of a downtrend. Here's the XLF. It looks stellar. I mean, financials have been on fire over the last little bit, ever since JP Morgan earnings, Goldman Sachs earnings, Bank of America, Citibank. They all knocked it out of the park. Mergers and acquisitions, America's open for business. They're all, fired up about this stuff. The chart looks great. New all-time highs, plenty of opportunity for a higher low. Brigade bolt back into blue sky territories, a deeper higher low off the 50 SMA. It's fine, right? So again, keep in mind that this component could offer some pullbacks intra-week, but generally it's not in a big bearish downtrend here out of financials. Healthcare, a little bit of improvement, and still watching out for the potential of the inverted head and shoulders. We are getting a little bit of that upper wick on Friday, rejecting the daily 200 SMA. I think a pullback would be fine here. If it was going to be stronger, the breakout should have stuck over the highs there at 147.50, and we would have just gotten continuation to the upside. So a pullback seems reasonable, really watching out to see whether or not healthcare can put in some sort of higher low. If it can, that starts to get the fourth heaviest weight component of the S&P back on sides with the bullish theme for the broad market as a whole, watching that closely. XLK, we've got some concerns over here. Red flag, start waving the red flag. Here we go. What do we have? Balance range rules are in play. We have failed the breakout back here. Obviously, the Monday gap down, deep seek stuff really weighing heavily on this chart, and just totally unable to recover the entirety of the deep seek gap. Keep in mind that the S&P index itself did. So if we start seeing larger breakdowns out of XLK underneath 230.25, I cannot sit here and say like, hey, everything's fine, guys, in the S&P 500. Don't worry about a thing. Just watch for that higher low. Let's be honest with ourselves here. If the XLK goes down, it's probably going to be a substantial headwind for the S&P as a whole. For anybody who's not familiar, you can check out the Analyze tab on Thinkorswim. Go to Fundamentals, just type in the S&P 500. Here you go, 30.68% of the S&P 500 is information technology. So as as the XLK goes, so does the S&P 500. All right, that is the name of the game there. So starting to become a little more concerned with this 230.25 and namely the double bottom neckline here at 227.75. If I zoom out on this chart, let's auto zoom so it fixes. That's this reference point, right? Big time double bottom. If we break below that, and you can thank Apple, you can thank Microsoft and NVIDIA for this. If those charts break down, it's not smooth sailing in the S&P 500. So we absolutely need to keep a very close eye on what happens here with the XLK. The Friday session, pretty ugly to me. We opened over the top of the Tuesday rally for a gap up there. There's a little bit of a push and not even a gap fill reversal. Here it is on the hourly time frame chart. No attempt whatsoever for a gap fill reversal. No hourly green counter trend move off of the Thursday high. Nothing. Straight back to the equal lows. So I don't want to be doom and gloom, and as we've seen so far, I think that there's enough wiggle room in the market for this to maybe resolve like that, at least keep us neutral on the XLK, but it's a top watch. It is absolutely a top watch. Here's the semiconductors ETF. This is pretty ugly as well, namely this balance range, big time move lower out of the DeepSeek news. Not a shock over here out of semis. One thing to think about from a themes perspective is that hardware, DeepSeek, if everything's true from the paper they've released, if all the claims are true, if you can train advanced models on older hardware and less of that hardware, then the premium that was priced into all of the semiconductor designers, manufacturers, all that stuff, it's got to take a little bit of a hit, right? The market, generally speaking, tries to look about 6 months forward. And if this is sort of indicating that, okay, maybe orders will be lesser in the future, that premium needs to get priced out of semiconductors. So, I'm not here to pretend to be an expert in AI or large language models, the training, the inference, all this stuff. I know some of the words, but regardless, that's the thesis here out of semiconductors. And the chart is respectful of that. Look at Friday's upper wick, nasty. Rejecting the 50 SMA, rejecting the midpoint of the balance range in here, closing underneath. Any further breakdowns of 237, and again, I think you have trouble on your hands. This will easily spill over into the XLK, obviously, but also just the S&P as a whole. So those are some top watches there. XLK, SMH, must-watch sectors. XLP looks kind of ugly here for a potential lower high underneath the bottom end of the overhead supply. The only thankful part about that is that it's D for defensive. It's also lightweight. It's not going to drive a majority of the gain in the S&P. Energy continues to put in its sine wave. So, Y equals sine, cosine, whatever, X, whichever function you'd prefer to use. It looks fine. Is there anything going on here that we should be abundantly cautious of? Probably not. Until this makes a new swing high or a new swing low, it's just going to be choppy in the range. It's going to influence inflation expectations, right? And we'll look at the PCE report in just a moment, but energy, such a small influence for the S&P in terms of weight. If we just go back to that Analyze tab, look at it down here, 3.2%, right? It's not going to move the needle. Let's go back on over to the charts. TLT, just to keep you posted on the bonds, of course, inverted head and shoulders. It's the opposite of what we have in the TNX, basically. I think it's still in play. I think there's an opportunity for a higher low. I think now that we're through the FOMC, Jerome Powell was pretty clear about his expectations. I'm not in a rush to cut rates, but we also don't think that market rates are accommodative right now. He thinks that they're still somewhat restrictive. I would argue on the contrary. Just to quickly bring up another chart here. If I bring up financial conditions, look at this. Oh, yeah, sure, Jerome. Very, very restrictive rates that you have right now. I mean, maybe from a mortgage perspective, right, and people trying to buy homes, but generally speaking, financial conditions have done nothing but ease as the announcement of the hiking campaign really is what did the most here ever since conditions have just eased. So do what you will with that information, but I don't think Powell has much to lean on when he says something like rates are restrictive right now. XLI, what do we have out of industrials? It's okay. It's fine. It's not really showing much of anything, really. It's got a multi-day balance range, maybe setting up a higher low. If we break the highs, it helps the case for the S&P, but it's not really going to move the needle all that much just because we're bouncing back and forth between these screens so much today. Industrial's still about 8%. As we get further through the list, keep in mind that real estate, materials, and utilities, take a look. I mean, the reason we spend so little time, or at least, we're not as serious about the analysis on these charts is because they hardly influence the S&P 500. They're much more of a sentiment gauge for particular industries and sectors, right? So real estate, we all know it's rate sensitive. It's fine. It has not made a new swing low. It'd be best if it could get back up and over. So there we go, 42.70. Something that looks like that is great, but we would need aggressive rate cuts from Powell. It doesn't look like that's going to be the case anytime soon. Materials, sideways, inside the range here. We can compare both both of these to the XHB, which actually is a little bit more concerning, just from a cyclical economy perspective, right? This kind of flip-flop right here, the more aggressive backing off into the end of last week underneath 113.75, it doesn't really spell the best outcomes for the S&P 500. Generally speaking, you want home builders to be moving in unison, at least just from a general trend direction point of view with the market. Utilities are last but not least. What do we have down here? We've got 77.50 being recaptured, potential for a higher low. It's deferred defensive. It's lightweight. It's helping the case. Anything up here helps the case for bullish S&P. If we make a new swing low, we'll be concerned. Let's take a look at the ratio charts. If you're not familiar with the ratio grid, check out the video tutorial in the top right-hand corner on how to set it up. Tech, as we've talked about, it's top watch. It's not really looking so hot here with the big new swing low underneath these previous pivots. So this is a red flag, and it might not have came off in the very beginning of the analysis there. I hope it did in the QQQ analysis, and anybody who's skipping the back half of the video, hopefully got the gist. But generally, it's really worth watching. I don't think you can ignore tech at this point, with the fact that DeepSeek news is influencing NVIDIA, Microsoft, earnings on Microsoft mostly. But those tech names are really staying suppressed here. They're not rallying. Financials look great, not a shock there. Healthcare, not an issue, and discretionary looks great. Really looking forward to Amazon earnings here shortly. XLC looks good. That's sort of more risk on. Industrial's a little bit more flat. This is not yet saying flight to safety. No flight to safety over here either. If we take a look at some specialized ratios, everything tech related, even semiconductor related, is going to be just almost obliterated, right? No good over here. This is telling us to take that cautious stance. This pure play, risk on, risk off from a discretionary and consumer staples perspective is a little bit more appropriate, I would say, in maintaining probably more of that bullish stance as the premium gets priced out of the tech sector right now. Just from a risk appetite perspective, this one makes a bit more sense to me to read into, instead of just like valuation fluctuation, so to speak. Another thing that we could do is you could just take a look at ARKK down here as a risk on, risk off gauge. It's not that we're trading ARK aggressively, and Kathy can, do her thing. That's fine. But this represents basically a basket of the most risk on stocks you can get. So if this breaks out, which it tried to do on Friday, that's more of a risk on sentiment. The fact that it's pulling back does not really strike me as being overly concerning. I think there's a chance for a potential higher low, especially coming from a higher high. It's not great that the breakout failed back under 63, but we'll continue to keep tabs on it here. ARKK as a risk appetite gauge, right? Let's take a look at the dollar. Let's get a little bit fundamental here. And we can see that the dollar absolutely rocketed primarily on Friday, and nobody should be shocked about that with the tariffs, and even Thursday rebounding off the low here. So any sort of continued move higher in the dollar up towards this 110 mark should in theory pressure equities to the downside. Remember that for every, I think it's 1% move that the dollar makes, it's about a 50 basis point move to the downside opposite for the earnings estimate in the S&P 500. So that is worth paying attention to. I mean, obviously, if you just want to use round numbers, there's about 2%, just round numbers, being around 100 here from 108 to 110. So you get the idea. That's a threat to the market. That is certainly more of a bearish data point. The same thing could be said about interest rates. Let's take a look at gold first, though. This upticking here, to me, is, again, purely based on the tariff announcements coming on Thursday and Friday. Of course, tariffs will be inflationary. Prices of everything go up. It gets passed along to the consumer, and suddenly we're dealing with 3%, 4% inflation again, right? That's what the market's saying, and that's what gold is saying. Hey, yeah, that's actually becoming a little bit more of a reality. In the initial breakout right back here, I would maintain that stance. That it's not a worry yet, but the fact that we've made this new equal high, if not higher high, yeah, the tariff stuff is absolutely beginning to look like more of an influence over the market potentially. Let's take a look at interest rates. Here we go. We missed that. So inverse to the TLT, head and shoulders, yeah, it's the pattern that's there. But if Jerome Powell is not in a rush to cut rates, and if inflation is reemerging as a threat based on tariffs, I wouldn't be shocked for higher out of the TNX. I would primarily continue to use 4.65 out of the 10-year as your line in the sand. If you're below, we're fine, and the head and shoulders lives on. If we're above, starts to put more pressure on equities, as of course we know the relationship goes. Let's take a look at the inverted ZT, which of course is backing off slightly. I think the market put to bed the fears of maybe a rate hike instantly, and Jerome Powell, as we talked about on Wednesday, in my view, really handled the meeting well from the Q&A perspective through the press conference. So You can see here we have about 83% odds of another pause going out to March, and then we have 47% odds of a cut coming in for the June timeframe meeting. We'll see if we get the 2 cuts or the 1. I'm really most curious about what happens in the second half of the year, whether or not we price in a second cut or if these start to shift back in this direction for only a single cut in 2025. This week, of course, will be massively influential with the labor report. We'll talk about that in a moment, only after we recap what happened here into the end of the week with PCE. PCE came in line with expectations across all of the metrics, and if we actually pull up the report here, what we know, and this was the same for the CPI report earlier on in the week, is if you look at energy goods and services, here we go. This is your basically total contribution to the uptick in PCE comes from energy, right? If you strip out volatile food and energy, I would say that that's a pretty normal read on the month over month here at a 0.2 from core PCE. If you look at the annualized figures, which I believe are down here, 1 month a year ago, the PCE 2.6, the 2.8 is the PCE. It's unchanged as you take out that energy, right? So energy in this column right here. From a year ago, it's actually down. Would you look at that, right? And you could just see that based on the CL in general if you were to look at crude oil. So getting back to the main point, though, of what we have on the docket this upcoming week, we're in an interesting spot where we will be getting, first of all, we'll just walk through the calendar sequentially. We have ISM manufacturing PMIs. That'll be influential. But then the labor stuff starts coming out. And this is kind of interesting to me because on the Thursday session, we got better than expected labor report numbers, but the market still somewhat produced a rally, right? There was a pullback, but then we rallied out of that pullback. And that's interesting to me because if the labor data continues to look good, it should, in theory, continue to suggest that Jerome Powell can keep rates higher for longer without having to worry about, like, oh my God, there's going to be an unemployment recession, right? So I'm really curious to see how these numbers start to give market reactions because we had seen this prior to last Thursday. Good news was bad news for the market, right? That's the normal inversion of the headline numbers. So I still think we're in that situation, but I don't know if the market is going to respond that way. And it really boils back down to, if you want to keep it simple, you could just at the end of the day check in with what's happening over here. If these boxes move to the right and we're not pricing in a second rate cut in 2025, that gives you your answer as to whether or not the market still perceives that the labor component is critical to whether or not rates go lower into the end of the year. So that's what we're watching for there. The weekly jobless claims really have not come in any magnitude of like, oh my goodness, the unemployment number is going to be off the hook. Like we're not expecting, or at least I'm not expecting any big change here out of the unemployment rate. I think a 4.1, a 4.2, well within the realm of possibilities here, which again is pretty good news, pretty stable. Jerome Powell said we welcome further stability in the labor market, right? You just think that it's found a better balance here was sort of to quote him and what he said on Wednesday. So any good news here, anything that's flat should in theory keep rates higher for longer. I don't see how it wouldn't with inflation not coming down towards their 2% target, especially with the tariff fears that were sort of ignited on Friday. So that's what we have upcoming. That's Friday at 8:30. We get the full Monty report. Keep in mind that we have the ADP non-farm preview on Wednesday, jobless claims on Thursday, and the JOLTS number on Tuesday, as we've seen here. I'll also point out, this is an honorable mention, 10 o'clock on Wednesday. ISM Services PMI will be a big deal. We want to watch for the divergence between new orders and prices paid. Are they diverging to suggest inflation, or are they moving in tandem, suggesting just straight up growth, right? Let's move along from that and take a look at the earnings insights. We did get a number of key reports last week. Namely, we had Microsoft, we had Meta, we had Tesla, and we had Apple. And a lot of the forward guidance from those companies is not looking so hot, and I think we're seeing that reflected in this right here. And that's primarily what we're concerned about next from an earnings standpoint, right? We'll dive into the reports when they appear to be appropriate, but for now, the guidance going forward is the issue, and you're seeing that in the estimates. So not a shock with that number moving slightly lower here. There's a big uptick out of Q2 for 2025, and we'll see if that ultimately becomes a reality. I'm not sure how it would be the case unless there's a dramatic lowering of rates that makes business easier to take place. The operating conditions get easier, right? Forex is not as much of an issue, right? That was really in Microsoft's earnings call a big issue for revenue is the exchange rate. The other thing would be like, unless there's a new AI structural breakthrough in these Magnificent Seven companies, I don't see why the Q2 earnings should come in at such an aggressive uptick relative to the negative forward guidance that we've gotten so far. Or even instead of saying negative forward guidance, just soft forward guidance that we've seen. The calendar this upcoming week is pretty jam-packed. Some honorable mentions here that I'll be watching for. Palantir, of course. Alex Karp. I may have to name my firstborn child after Alex Karp because that, and a lot of retail here, I'm not claiming to be the only one or a genius. A lot of retailers absolutely crushing it on Palantir, so let's look for a good report on Monday after the close from a swing/investment perspective. AMD, Alphabet, of course, on Tuesday. We have Qualcomm ARM on Wednesday. Amazon, of course, on the Thursday session. Those are the honorable mentions that I would pay the most close attention to. Beyond that, maybe PayPal. Spotify is interesting there. Snapchat, Chipotle, the world's most expensive burrito, which, of course, after the split is no longer. Uber, Disney. Novo does move the healthcare sector a little bit. I would probably say something like your BMY is a little bit more impressive. Eli Lilly, certainly. I don't know how I missed that, actually. That should be in a firm box up here. That will be a watch on Thursday before the open. All right, Fortinet as well. From a cyber perspective, pretty interesting. FTNT is the ticker on that Thursday after the close. And that is the earnings calendar for this upcoming week. Ferrari race, it's a classic. You can always watch that on Tuesday before the open as well. Let's get back on over to the platform. Let's finish up today's analysis. It is a long one with those monthly time frame charts. I appreciate you guys sticking with me. TLT ratio to the S&P 500, not an issue. No flight to safety just yet. Needs to flip into an uptrend there, and then we'll be concerned. We do not have that. Bonds relative to themselves, still trying to formulate these new downtrends. However, with the tariff news, I wouldn't be surprised if these hook back up and make equal highs, which again should be some downward pressure for our equities market down there. If we take a look at credit spreads, they are ticking slightly higher, so volatility is increasing. Namely, the corporate grade, the LQD, is most influential here, given what's going on with the tariffs, I think. Moving to, let's go HYG. There we go. This actually has a positive and bullish divergence with the broad market into the end of the week here. The only thing that maybe neutralizes that a little bit is if we just go out to a daily time frame chart, we know that relative to like this previous high, right? We're not even close. Whereas if we do the same thing in the S&P 500, we're actually already above. So it depends on your time scale of divergence versus non-divergence. If you're using the hourly back-to-back, it is technically bullish on the HYG to end out the week. And we can actually swap in the LQD, which here you can see, again, from the corporate grade side, actually suggests a little bit more of a negative divergence still. The shorter time scales, just to continue to traverse both of these perspectives, right? It does help that we're over this horizontal level, and it does help that this is an uptrend here. Not a meaningful breakout though. Like relative to this previous set of highs, this here, it's just not even close, right? So corporate grade is still somewhat of a slug there relative to the S&P. Bitcoin, in terms of a risk appetite gauge, is technically firing a bearish Sailor shift signal. Someone asked the other day where this study can be found. It's actually on our website. Just go to tradebrigade.co/trading-scripts if you're interested in that. It's the Sailor shift ratio. You can build it on your own. If you want to save the headache and the math of putting it all together, you can just download it from the site. Anyways, it would suggest underneath these lows, it's reasonable that you might see a bit more of an aggressive pullback. And I mean, this is A-okay. I mean, we've had nothing more than bullish consolidation up here. We don't have aggressive sellers. If we get a little bit of distribution and a sell-off, the next opportunity is really just looking for a long off of 71.5. We're not there yet, but this is starting to suggest a change in tone. For now, if we're over 94,650, I would suggest that the risk appetite remains elevated for equities and financial products as a whole. If we look at the total breadth, we're continuing to manage against this previous example back here. The things that are positive so far is the move over the 50% mark, the fact that the green line never went negative. We're also still above the 0 mark out of the new highs versus lows. So far so good. Breadth expanding here is helpful, but we're keeping a close eye on this as well. The easier way to watch it if you don't want to set up a study screen like that is just using the RSP. As long as this pulls back and stays above 178, we are good to go from a breadth expansion perspective. QQQE is similar in the sense that you just want to see this higher low maintained. So far, so good. If we look at Dow Industrials versus transports, a little bit of a red flag happening down here, which is not a surprise considering what we've talked about so far with the IWM, of course. Let's move along to volatility, which I'm surprised it did not perk up more than it did on the Friday session. Notice that we're just, a hair off the 15 handle in the VIX. If we look at the VVIX, it's again still underneath that 103, not as big of a move in the upside as I would have thought. And even the volatility spread through the contracts here, they took a hit, but we didn't see any inversion. There's no move of this white underneath this gray, or this gray underneath this gray, or this gray underneath the deepest gray. Nothing. All of these are still over the zero mark, tariffs or otherwise. The market seems to be, from a vol perspective, holding up okay. If these did invert, relationship-wise or just net under zero, that'd be a pretty big red flag, but we have not seen that yet. So continuing to keep an eye on those volatility posture contracts. One thing we can say actually is down here in the one-day VIX, we are back at these highs. And I think, it's going to be a long time before we're actually suppressed into an era that maybe looks like that. I think the one-day vol is just going to expand to be the entire range or just the upper bound in here, given what we've seen so far from the administration. Big changes, rapid changes. Of course, the market has to adapt to that. And volatility is responding appropriately. If we look at the skew, because I brought this up in last weekend's update, it has come in aggressively, so a little bit less of that tail risk being priced in relative to last week. It's still elevated overall. It's still trending in the upward direction, but less of that sustained move going sideways. And keep in mind that that was an all-time high. Let's rip through the core list of companies and let's see what's going on from that perspective. I'll get you out of here with 3 trade ideas and you can enjoy your weekend. What do we have out of NVIDIA? You've heard my thesis on this for a very long time now. And by a very long time, I just mean all of last week. If we're under 129, there's too much overhead supply. It's very, very difficult to have an optimistic stance here if you have all of this. I totally understand the viewpoint that on the weekly time frame chart, oh my goodness, look at the trend line. It's so pretty. It's right off the 50 SMA. It's got to be a dip buy. I don't believe it. You do whatever you want and that's fine. Everybody rushing out to buy NVIDIA, I think that's okay. I don't think NVIDIA is going anywhere. I'll frame it that way, but I do think that, the better place to be long NVIDIA is much further down towards like 100. I would prefer to see this continue to act as this is a double top. We talked about how this is a weekly high or low because technically there was a daily downtrend here. You've heard this, right? So I'm of the belief that if we're under 129, a weekly downtrend emerges and it wouldn't be unreasonable to get down into this area. Earnings, of course, can change this and that's yet to be seen. But for now, just based purely on supply and demand metrics and, this overhead supply that we've referenced now a number of times, I think it's very difficult to try to stick your neck out there on the line and say, hey, I want to be the first one in the door on NVIDIA. And, that's fine if you've got a tiered approach. If you want to take like a quarter of the position size here in the long term and then add to it as it gets towards 100, you don't want to miss the move in case it does do something like that. That's fine. I'm not telling you how to manage your money and, you do whatever you want on NVIDIA. But from a trading perspective, being underneath 129, at least just give this the respect it deserves, right? And on Friday, pretty ugly close, back down underneath the daily 200 towards the bottom end of this balance range. It's a very simple chart to watch. You either get a Brigade bolt over 129, the range doubles and closes the deep seek gap. That's pretty impressive, and that's totally within the realm of possibilities. I'm not saying that can't happen, but it would need to break 129 first. I'm not speculating on a long if we're underneath the overhead supply inside of this balance range. If it breaks the lows, it's the same concept. And what would a range double bring us here? Just shy of, this is based on an eyeball test, just shy of 101.11. 101.11, how did anybody let that slip? That's got to be 101 flat, round numbers only up here in the penthouse. My goodness. Jeez, I have no idea. No idea how that happened. On the hourly time frame chart, not much going on. Just chop it around sideways. Be my guest if you want to get chopped up in here. Are there decent moves for quick draw McGraw? Sure, absolutely. But for now, not much going on. We spent too much time on that, so let's breeze through some of these other things. Microsoft, I think the chart's horrific. I was really hopeful that earnings would have sent us here or sent us here. Obviously, with the move lower, it looks like this might be a better priority out of Microsoft. But at the same time, risk-reward-wise, towards this support, I don't want to be a short into the support. It actually does suggest a trade that looks like this. Range traders maybe have something going for them there, but I prefer trends that are much cleaner than this. I'm almost just tempted to stay away from Microsoft inside of this sideways balance. They need something that suggests the new forward guidance was like totally out of whack. And, oh my God, how could you have possibly said that? Amy Hood there in the conference call. Like, what do you mean forward guidance doesn't look good? We have all this stuff going for us. If that takes place and they take it back, maybe off the bottom end of the range, but from a trading perspective, I'm really not that interested in this chart. And one of the themes, right, you'll notice this actually, and you could put the pieces of the puzzle together. I've not been very fond of NVIDIA since the deep seek gap down under 129. Microsoft, ahead of earnings, I was like, please give us something outside of this range so the chart can trend. That hasn't happened. There's honestly not a lot of great looking charts out there opportunity-wise from the daily perspective. So what does that mean for the S&P 500? Is it hard to maintain that bullish stance here? I think we've sort of covered it with the XLK analysis, but it's just sort of reinforcing that point. Anyhow, let's move along to Apple. Apple's, I mean, it's trending in the sense that it has some decent movement to it in here. It's not just completely sideways like it was in this box. The earnings call and I guess generally the earnings session was just no good into the Friday there. Not really thrilled with the close back underneath this level. I think that if the buyers were going to make something happen, it should have stayed well above 237.25, this previous weekly breakout area. So again, these like top heavyweight components of the S&P 500 in isolation, very difficult to say constructive things about this chart. It's an outside engulfing bar, earnings gap up. I mean, the first thought would have been, okay, you open here, partial gap fill reversal, buyers are in control. Full gap fill reversal, buyers remain in control. Okay, some support off the weekly level, buyers might remain in control. Where do we close? Underneath all of it. So very hard to say optimistic things here about Apple from the daily or even hourly chart. I think that we just, you can take the levels down that we have on the screen, but it's day by day here. There's really nothing in the aftermath of that Friday, not much. Amazon, it's been a money printer, so thanks to Jeff Bezos for that over the span of last week. Earnings this week will slow it down a little bit from an activity perspective in my mind. I want to stay away from IV crush on the options chain, but nonetheless, this chart is just, here's an exercise. How does this Amazon snapshot right here compare, in your opinion, to Microsoft? I mean, come on, it's night and day between where there's opportunity in this market and where there's not. Amazon is cleanly trending in the upward direction. Brand new record highs, clean sets of higher lows. It's very obvious to me where the focus should be in the market right now. It's not NVIDIA, it's not Microsoft, it's not Apple, it's Amazon, right? It's Google even. Look at Google finally breaking out of this balance range here, over 201.50. That looks great. It's Meta. Look at Meta. I mean, come on. It's very, very clear where the opportunity is. I know we've just sort of breezed through some of these charts, so we'll go back to Amazon briefly. Be respectful of earnings, please, but consolidation over 232.50 sets this up for a move into blue sky territory. That's over 241.15. I would not be bearish on this chart. The daily trend is too clean. If it is going to turn bearish over time, show me this, and then we'll change our tone when the trend appropriately flips. Google on the breakout of the balance range. I do not want to see it back into the balance range, obviously. That's look above and fail. That would be bearish. Maybe we'll take it for a lower high post earnings if that setup persists. But for the most part, I would like to see this and higher over time. That's 201.50. Metaverse, earnings in the rearview mirror now. Looking a little bit top heavy here, but that's okay. Any sort of pullback on the daily time frame chart, I know it would be unconventional and possibly not, the easiest thing psychologically to play along with, but this looks fine. Anything over this retest shelf looks really, really great as an opportunity for Meta. Inside bar on Friday, underneath these two equal lows. Here it is on the hourly chart. Maybe this turns into a double top. Heck, we could even call it a Man Ray pattern, right? And here is where we start to get that deeper pullback. So this, I think, is a much better trader. I mean, the levels are very obvious. The structure and the price range that this has been traveling these days is way better. The price point's right on, right? So really love Meta based on these levels. For the most part, base case, consolidation, Brigade Bolt, the blue sky territories. Secondary would be this, taking A to B, reevaluating at B. If it breaks the neckline, stronger retest of the daily breakout at 635.25. Next up, Tesla. Let's get back into comparison mode. In here, it looks great. I will definitely concede that point. But through this, not real. Like we could get all sorts of all over the place with the drawing tools. This is not a clean trend. This is just a balance. Is it possible that this turns into a double bottom? Over time, maybe. But what does that mean? You've got to be over the neckline at 439. We are rejecting via the upper wick on Friday, the previous all-time high. I don't even think it's going to show up on this screen. We don't have enough time loaded up, but that's fine. So that's not really great. If you look at the hourly time frame chart, this is, whoa, funky zoom, thinkorswim. This is not trending cleanly. We're between a rock and a hard place, as I've dubbed it the past couple of sessions, right? You technically have head and shoulders here, neckline. Then you have double bottom on the hourly, neckline. I mean, you're between that. So until 410.25 resolves cleanly in the upward direction, or until 400 resolves to the downside here, really more interested in like getting out of this box out of Tesla than anything else. And one more time, I think it's clear where the opportunity is. It's Amazon, Google, Meta. It's not so much Tesla right now. The darling is no longer being a darling. Here it is out of JP Morgan. Financials look great. It's always good to have this on the watch list because it's a good reminder that financials are the second heaviest weighted sector in the S&P 500, coming in at 12.36%. And having this on the watch list continues to remind me that, okay, if tech is sideways to down, but financials are up, we probably don't want to be aggressive shorts in the S&P 500. Maybe we don't want to be long, but we probably shouldn't be short the market. So that's a good one here to have. JP Morgan looks great. Consolidation, Brigade bolts. If it is top heavy, fine. Any pullbacks through this range are great. I would entertain shorts for the thin structure retracement if we fail underneath, 260.60. Right, so that's the level there. Netflix, show me the earnings breakout. I'm waiting. Show me this. Where is it? We'll give it, as much time as it needs, but $9.99, $99.99 at the highs, and then $9.50.25 is the earnings gap to the downside. This is a false upper wick, so please go based on this level here at 874.20. Let's get into these 3 trade ideas, and then you're on your way for the weekend. RCL, Royal Caribbean, makes the cut this week. What do we have? I think that there's a clean, thin structure retracement move to the downside that could be had here. This is a bearish engulfing bar on the Friday session. Now, obviously, the tariff news has something to do with that, but this was even trending down off of the open, right? So remember that the S&P was trending higher off the open, and then it dumped into the afternoon, whereas RCL was already experiencing some pain ahead of the move. So the tariff stuff there just exacerbated what was already taking place, and we have this as potential overhead supply. Brigade Bolt, look at that juicy thin structure retracement off to the left. I mean, we're talking about an opening print target down here at 246.85. For round number's sake, that'll do. You could talk about a full gap close down here to 237.50. It doesn't have to happen all in one fell swoop, but generally speaking, I would be more partial to some sort of short through the thin structure if the lower high can be set. I want to be clear about that because on the daily time frame chart, we did just make a brand new swing high. So let it break first, turn this into overhead supply, and scalps can absolutely take place between A and B. That's 265.25, 246.85, 237.50. Next up, another R name. We have ROKU, Roku. This is just something to monitor. I don't know that it's in play instantly given the Friday pullback, but if we can sustain a higher low on the daily, you could start to draw this in as an ascending triangle. I'm primarily interested in the flat highs and the fact that there's still a gap to close off to our left here. That's over 86.75 into 91.15 as a potential idea. The higher lows need to stay above 80.25 if this is going to remain what I would consider like a decent setup walking forward. If it breaks underneath, too much of a sideways balance, probably losing a little bit of interest there in lower tier tech as I'd consider it. That's Roku. Last but not least, this is an iffy one, MSTR, MicroStrategy. We saw the Sailor shift ratio firing off bearish, right? What do we see over here? Technically a little Brigade Bolt starting to brew on the daily time frame chart underneath a whole heck of a lot of overhead supply. They had opportunity number 1. It failed. Opportunity number 2. Oh my God, let's rejoice. It's got to do this. Michael Saylor makes the cover of Forbes. You know how that went for Sam Bankman-Fried. Not so well. Let's see if this ultimately comes back on down to 276.25. Please mind earnings here. It's tied almost, I don't want to say directly to Bitcoin's price, but it's very correlated to Bitcoin. So also, if you even consider trading MSTR, please also have a chart of Bitcoin up as well at the same time. It's a tertiary idea here. It's something to be mindful of. I like the inverted hammers. I like the bearish Brigade Bolt under 360. We'll see if it ultimately plays. Someone could also probably make the argument in here. You've got a trendline break that could also take place to send you to the apex of the triangle. With that said, I appreciate everybody coming out to the weekend update analysis. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We will be live every single day of the week, every day the market's open. We do the pre-market prep right here on the channel, 8 o'clock Eastern time. Come hang out with us for the morning show. It's always a good time. We crack some jokes. Sometimes we have coffee and donuts, and we set you up with a nice trade plan for the day's session. We hope to see you there. If not, I will see you in the next one. Have a green trading week.